Silver hasn't moved. That's the problem. While gold pushes records, Bitcoin flirts with volatility, and the Fed whispers higher for longer, silver is compressing. But this isn't stability, it's pressure. And when silver finally breaks equilibrium, it won't be 5%, it will be 30%. In one direction, gold is breaking out, silver isn't. That divergence is the shock. Gold pushes toward historic highs on relentless central bank accumulation, persistent geopolitical stress, and a steady bid from sovereign balance sheets diversifying away from the dollar system. Real yields remain elevated, yet they've stopped rising. The upward pressure that suppressed gold for 2 years is flattening, and gold has responded immediately. Silver has not. The gold-to-silver ratio remains lodged near the upper end of its historical band, signaling persistent underperformance. In prior cycles, when gold surged on macro stress, silver eventually followed with amplified beta. Today, that reflex is missing. Silver is range-bound, compressed, indecisive. That's not normal. Real yields are still restrictive, but they are no longer accelerating higher. Meanwhile, the Federal Reserve continues quantitative tightening on paper. Balance sheet contraction persists. Yet liquidity isn't draining uniformly. The reverse repo facility is being drawn down, quietly re-injecting reserves back into the system. Treasury issuance is heavy. Repo markets remain structurally fragile. Liquidity is tight, but not collapsing. This is an equilibrium trap. Global manufacturing PMIs, after months in contraction, are stabilizing, not booming, stabilizing. If silver were trading purely as an industrial metal, that stabilization should provide support. Green energy buildouts, electrification demand, constrained mine supply, the structural floor exists. But if silver were trading purely as a monetary metal, gold's breakout should be pulling it higher through correlation gravity alone. It's doing neither decisively. That tension is the story. Silver is pinned between two macro regimes. Tight monetary policy suppresses speculative positioning. COMEX data shows hedge funds reducing net long exposure, unwilling to press leverage into a high real rate environment. At the same time, structural supply dynamics prevent meaningful downside. Physical inventories remain constrained relative to long-term demand trajectories. The result? Volatility compression. Options markets are pricing complacency. Realized volatility has collapsed relative to prior stress cycles, but macro inflection points rarely announce themselves with noise. They arrive after compression, and liquidity beneath the surface remains fragile. Treasury market depth is thin. Repo plumbing has shown periodic stress. Institutional positioning is cautious, not confident. Silver is not calm. It is conflicted between deflationary pressure and monetary repricing. Markets do not remain neutral when regimes shift. And when compression resolves in a metal straddling both industrial demand and monetary distrust, the move is rarely incremental. The silence here isn't stability, it's tension waiting for direction. Now we move from narrative to positioning, because price is one thing, but exposure tells you who actually believes the move. CFTC data shows managed money net length in silver futures sitting well below historical extremes. Hedge funds are not aggressively long. In fact, net positioning has been reduced materially over the past quarter. There is no euphoric speculative buildup. No crowded trade. CME open interest reflects the same restraint. Participation is stable to slightly declining. There's no surge of new leverage entering the market, no evidence of speculative momentum building beneath the surface. Silver ETF flows reinforce that apathy. Holdings have been flat to mildly negative. Capital is not aggressively accumulating physical-backed products. Retail participation remains muted. Institutions are not rushing to increase exposure. But here's where it becomes more nuanced. Commercial hedgers, producers, and bullion banks have modestly increased their short hedges. Not dramatically, not at extreme historical levels that typically mark cycle tops, just incrementally higher. Historically, when commercial shorts reach extreme levels, it signals an overheated market vulnerable to correction. We are nowhere near that condition, which creates ambiguity. There is no extreme positioning to unwind, no excess froth to purge, no crowded longs to liquidate. And that absence of imbalance means something critical. The next directional move doesn't require a positioning reset. It can build quickly. Volatility markets confirm the complacency. Implied volatility sits near the lower end of its multi-year percentile range. Option skew is relatively flat. There's no heavy demand for downside protection, no aggressive call buying either. Stability is being priced as the base case. Meanwhile, macro liquidity dynamics remain tight. Treasury issuance is elevated. The Fed continues signaling patience. No imminent pivot, no rapid rate cuts. Real yields remain restrictive, and capital is flowing elsewhere. AI-driven equities are absorbing incremental liquidity. Crypto markets are attracting speculative rotation. Risk appetite exists, but it's bypassing silver. That neglect is dangerous, because silver's positioning reflects low conviction across the board. Hedge funds aren't pressing longs. Commercials aren't signaling panic. ETFs aren't accumulating aggressively. Volatility markets are asleep. When conviction is low, moves tend to be violent. Here's the institutional dilemma. If liquidity tightens further and real yields grind higher, silver struggles under the weight of opportunity cost. But if real yields roll over decisively, even slightly, the absence of heavy short exposure could allow momentum to build rapidly. Are banks simply hedging prudent downside risk into a fragile liquidity backdrop? Or are they quietly positioned for a breakout while speculative money hesitates? The trap tightens in the space between those two possibilities. Now we shift from positioning to plumbing, because silver's real tension isn't just who owns it, it's how it's structured. Start with COMEX inventories. Registered silver, the metal actually available for delivery, has trended lower over the past 2 years. Total warehouse stocks fluctuate, but the registered category remains thin relative to historical norms. At the same time, open interest in paper contracts represents a multiple of that deliverable supply. In some periods, paper claims have exceeded available registered inventory by 20 times or more. That leverage works until it doesn't. On the supply side, global mine output has stagnated. Primary silver miners represent a minority of production. Most supply comes as a byproduct of copper, lead, and zinc mining. That means silver supply growth is constrained by base metal economics, not silver price alone. You can't rapidly scale silver production without broader industrial expansion. Now, layer in demand. Solar installation growth continues at double-digit rates globally. Photovoltaic manufacturing capacity expansion, particularly in Asia, is absorbing significant physical silver. EV electrification, grid upgrades, and semiconductor applications add incremental pull. Refinery bottlenecks and geopolitical trade frictions further complicate flows. Physical demand remains resilient. But here's the friction point. Industrial buyers hedge through futures markets. They lock in forward pricing via paper contracts, so tightness in physical supply does not automatically trigger price spikes. As long as futures markets function smoothly and delivery stress remains contained, paper absorbs pressure. That's the equilibrium. Physical fundamentals suggest a structural floor, persistent deficits over the medium term, constrained mine growth, expanding green transition demand. Financial liquidity imposes a ceiling. Silver trades in dollars. It responds to real yields, dollar strength, and funding conditions. If a broader liquidity crunch emerges, repo stress, treasury market volatility, forced deleveraging across hedge funds, silver can trade like a risk asset. It sells off alongside copper, equities, even crypto. Physical tightness doesn't immunize it from margin calls. This is what makes silver uniquely sensitive. It sits between copper and gold, between industrial cyclicality and monetary distrust, between growth and fear. When liquidity is abundant, silver can act like a high-beta monetary asset. When liquidity contracts, it behaves like an industrial commodity tied to risk appetite. That duality turns silver into a pressure valve. Structurally, the long-term case is constructive. Supply deficits, energy transition demand constrain new projects. But short-term, liquidity dominates fundamentals. If confidence in paper leverage cracks, If delivery stress materializes or counterparties hesitate, price gaps higher violently as contracts scramble toward physical. If liquidity freezes instead, silver trades down with everything else. Two completely different reactions, same metal. Now we split the path forward, because silver is no longer drifting. It's compressing toward resolution. There are two realistic outcomes, the 30% upside scenario. Catalyst 1, the Federal Reserve signals easing, explicitly or implicitly. That could mean rate cuts, arriving faster than expected. It could mean balance sheet expansion returning under the guise of market stabilization. The mechanism matters less than the liquidity impulse. Real yields decline sharply. The dollar weakens, financial conditions loosen. Gold breaks higher first. It always does. But silver historically accelerates faster during late cycle easing. In prior cycles, once monetary pivot expectations become credible, silver compresses the gold-to-silver ratio aggressively as speculative length rebuilds. That's where positioning becomes fuel. Managed money exposure is currently muted. It doesn't take extreme short covering to trigger upside momentum. A modest rebuild in speculative length can cascade quickly when volatility expands. COMEX inventory stress, even modest delivery tightness, would amplify that move. Add a surprise acceleration in solar demand or supply disruptions, and the paper market suddenly has to reprice physical scarcity. Upside volatility expands. The gold-silver ratio compresses, silver overshoots. Now the other side, the 30% downside scenario. Catalyst, a hard recession shock, equity markets roll over aggressively. Credit spreads widen, liquidity evaporates, Treasury issuance collides with risk-off positioning, and the dollar spikes as global funding tightens. Real yields remain elevated, not because growth is strong, but because policy remains restrictive relative to collapsing demand. In that environment, silver trades like an industrial metal. ETF outflows accelerate, speculators exit, hedge funds reduce exposure to meet margin calls elsewhere. Industrial demand expectations are revised lower. Copper weakens, and silver follows. Gold likely holds up better, supported by safe haven flows and central bank buying. Silver underperforms. The gold-to-silver ratio expands toward historical stress extremes. Both paths are plausible, and that's the tension. Silver itself is not choosing direction. The physical market provides a floor. Paper leverage provides a ceiling. But the decisive variable is liquidity. If global liquidity expands, silver behaves like high beta monetary insurance. If liquidity contracts violently, silver behaves like a risk asset with industrial exposure. The Federal Reserve and broader global funding conditions, will determine which regime dominates. Weighting feels neutral, but in a compression phase like this, neutrality is still a position, and when liquidity breaks one way or the other, repricing won't be gradual. We are approaching an inflection point. Silver volatility is compressed. Liquidity conditions are unstable. Positioning is neutral. That combination does not persist. When volatility collapses while macro uncertainty rises, markets are storing energy. Silver's realized volatility sits near cyclical lows. Options markets are pricing stability. Yet funding markets remain sensitive to Treasury supply shocks, reverse repo drawdowns are altering reserve dynamics, and real yields are elevated relative to long-term growth capacity. Compression against instability is not equilibrium, it's pre-movement. Three structural takeaways matter now. First, liquidity determines direction. Watch the Federal Reserve's balance sheet trend. Watch reverse repo balances as a proxy for reserve migration back into the banking system. Watch Treasury issuance and how it's absorbed. Silver responds to liquidity before it responds to industrial fundamentals. If reserves expand and real yields decline, silver will front-run that easing. If liquidity tightens and funding stress rises, silver will price that contraction quickly. Liquidity is the steering wheel. Second, gold leads, silver amplifies. Gold has already broken higher under restrictive policy. That leadership matters. Historically, when gold sustains a breakout and real yields roll over, silver's lag becomes untenable. The gold-to-silver ratio compresses aggressively during monetary transitions. Silver doesn't drift upward in those phases, it accelerates. Catch-up rallies are rarely orderly. They are momentum-driven and positioning-fueled. If gold continues to strengthen, silver's underperformance becomes unstable. Third, physical tightness is a slow fuse. Structural supply deficits, constrained mine growth, solar and electrification demand. These forces build gradually. They do not trigger price spikes on their own, but when paper confidence wavers or liquidity turns supportive, that underlying tightness removes downside elasticity. The market discovers there is less buffer than assumed. Slow fuse, sudden ignition. Now the binary reality. Either liquidity tightens further, real yields remain elevated, the dollar firms, risk assets correct, and silver flushes 30% lower as it trades like an industrial commodity in a funding squeeze. Or easing pressure emerges, balance sheet expansion, falling real yields, renewed risk appetite, and silver reprices upward violently, compressing the gold-to-silver ratio in weeks, not quarters. There is no soft landing inside equilibrium traps. Upcoming Fed meetings matter. Debt issuance cycles matter. Geopolitical escalation risk remains elevated. Equity markets are priced for resilience, but vulnerable to shock. Silver is not asleep. It's waiting. And when this equilibrium breaks, it won't whisper. It will move 30% fast.